You've probably heard you can salary sacrifice up to $30,000 into super this year and pay just 15% tax instead of your marginal rate. And if you're earning a solid income in your late 50s, that sounds like a no-brainer. But here's the thing most people don't say out loud. The majority of Australians in their mid-50s don't have a spare $30,000 sitting around to tip into super. Between the mortgage, school fees, car repayments, and just the cost of living, the budget is already stretched. So when you search for retirement planning strategies and every article starts with salary sacrifice and big lump sums, it's easy to feel like these strategies aren't for you. But that's not true. There are three moves that work even when your budget is tight: the government co-contribution, the spouse tax offset, and the downsizer rule. And together they could add tens of thousands to your retirement savings without requiring you to change your lifestyle at all. The co-contribution alone can hand you $500 back from the government for a $1,000 personal contribution. That's a 50% return before you've done anything else. We'll get into exactly how each one works, the eligibility rules, and the one hidden trap that could cancel out the benefit if you're not careful. If you're a pre-retiree on a tight budget who wants to boost super without sacrificing your lifestyle right now, hit subscribe. Because what we're covering today is the kind of detail most financial planners don't have time to walk you through. Let's start with the easiest free money available to Australian super members right now. If your total income is $44,500 or less this financial year, and you put $1,000 of your own after tax money into super, the government will deposit $500 directly into your super account. No forms to chase, no complicated process. The Australian Taxation Office calculates it automatically from your tax return and pays it directly. That's a guaranteed 50% return on a $1,000 investment. No savings account, no term deposit, nothing legal and low risk comes close to that. This is called the government co-contribution, and it's been sitting in the tax system for years. It's not a loophole. It's not something reserved for financial planners who know a secret. It's a program the government designed specifically to help low and middle income earners build super. The problem is, most people earning around that threshold don't realize they qualify, or they assume it's too complicated to bother with. Here's how it actually works. The full $500 co-contribution kicks in when your income, including any reportable fringe benefits and salary sacrifice amounts, sits at $44,500 or below. Above that, the co-contribution starts phasing out, and it reaches zero once your income hits $60,400. So if you earn $50,000 this year, you'd still get a partial co-contribution. Not the full $500, but something. The $1,000 contribution you make has to come from after-tax money. It can't be a salary sacrifice amount. That's a different bucket. You're making what's called a non-concessional contribution. You pay it out of your bank account, into your super fund, before the 30th of June. That's the deadline. The ATO then cross-references your income from your tax return and deposits the co-contribution automatically. Why does the threshold sit at $44,500? Because the government co-contribution was designed to target people who are working but don't have enough disposable income to make large voluntary super contributions. If that sounds like your situation right now, maybe you're working part-time, or you had a lower income year, this is the strategy for you. It's the definition of meeting the system where it is. This isn't a trick or a loophole. It's a government program built for people like you who are working hard and trying to get ahead, but don't have a spare $30,000 to salary sacrifice. And it costs you just $1,000 out of pocket to get a $500 return. If you can find that in your budget before the 30th of June, this is one of the simplest moves you can make. The co-contribution is the easiest of the three strategies we're covering today. The second one is even more powerful if you have a spouse, and it's one most couples completely overlook. If your spouse earns under $37,000 a year and you put $3,000 into their super account, you get $540 back as a tax offset, not a deduction, a direct reduction in the tax you owe. That's 18 cents back for every dollar you contribute, up to that $3,000 limit. And it doesn't require any special setup. You just make the contribution to your spouse's super fund and then claim the offset in your tax return. Take Sarah and Mark. Sarah works casual hours, earning about $35,000 a year. Mark earns $120,000. By making a $3,000 contribution to Sarah's super, Mark gets $540 taken straight off his tax bill. Over 10 years, assuming they keep doing this, that's $5,400 in tax savings. And on top of that, Sarah's super balance grows, with earnings compounding inside the super environment at a much lower tax rate than she'd get outside. The eligibility rules are worth knowing precisely. The receiving spouse, in this case Sarah, needs to have an assessable income under $37,000. That income figure includes reportable fringe benefits and any salary sacrifice above the standard employer contribution. The offset phases out between $37,000 and $40,000 and disappears completely above $40,000. So if your spouse earns $38,500, you'd still get a partial offset, just not the full $540. I used to think you needed a large lump sum to make spouse contributions worthwhile. That it was one of those strategies that only made sense if you had serious money to move around. But $3,000 is less than $60 a week. That's one less takeaway meal most evenings. And the return you get, $540 back in tax, makes it one of the highest returning moves available to a couple in this income bracket. What makes this strategy particularly valuable is it addresses something most super strategies ignore: the imbalance between two super balances inside a couple. When one partner earns significantly more than the other, their super tends to grow much faster. Spouse contributions are one of the few tools that let you legally redirect money toward the lower balance account and get a tax incentive for doing it. The other piece worth understanding: the $3,000 you contribute to your spouse's super is a non-concessional contribution. So it doesn't count against the concessional cap. It counts against your spouse's non-concessional cap of $120,000. For most couples, that's nowhere near an issue, but it's worth knowing the structure. Now, the third strategy is the biggest of all three, but it also carries the most significant trap. If you get it wrong, you could hand back thousands of dollars in tax benefits without realizing it. If you're 55 or older and you sell a home you've owned for at least 10 years, you can put up to $300,000 from the sale proceeds directly into super. If you're a couple and you both qualify, that's $600,000 between you. And here's the part that makes this unlike almost any other super strategy: that $300,000 sits completely outside the normal contribution caps. It doesn't count against your concessional cap of $30,000. It doesn't count against your non-concessional cap of $120,000. It's a separate category entirely. For most people who are approaching retirement with their biggest asset being the family home, this is a genuine opportunity to move a significant amount of wealth into the super environment, where earnings are taxed at either 15% in accumulation or 0% in pension phase, without the usual contribution restrictions getting in the way. The rules are fairly straightforward. You need to be 55 or older at the time you make the contribution. The home must have been your main residence at some point. It doesn't have to be your main residence right now, but it can't be a pure investment property. and you must have owned the property for at least 10 years. The contribution needs to be made within 90 days of the settlement date, and you need to notify your super fund using the right form before or when you make the contribution. Now, the trap. If your total super balance is already sitting close to $2 million, which is the transfer balance cap for 2025-26, then depositing $300,000 could push you over that limit. And once you exceed the transfer balance cap, you can't transfer that excess amount into the pension phase of super, where earnings are completely tax-free. Instead, that money stays in the accumulation phase, where earnings are taxed at 15%. On a $300,000 balance earning 7% a year, that's roughly $21,000 in annual earnings. At 15%, you'd be paying around $3,150 in tax every year, indefinitely, that you wouldn't be paying if the money had stayed outside super or if you'd contributed when your balance was lower. Over 10 years of retirement, that's more than $31,000 in unnecessary tax. So the strategy that looked like a $300,000 windfall becomes a slow tax drain if you're not paying attention to your total balance first. The fix is simple. Before you make a downsizer contribution, check your total super balance. If you're within $300,000 of the $2 million cap, talk to a financial advisor about how much you can safely contribute. You may not be able to use the full $300,000, but even a partial contribution, $100,000 or $150,000, can still be worth doing if the alternative is keeping those funds outside super, where earnings are taxed at your marginal rate. The downsizer is the most powerful of the three strategies we've covered, but only if the timing is right and your total balance gives you room. Next, let's look at a strategy that sounds simple, but has a trap of its own: the carry-forward rule. Each year, you can contribute up to $30,000 into super as a concessional contribution. Employer super plus salary sacrifice plus personal deductible contributions. If you don't use the full $30,000 in a given year, that unused amount doesn't disappear. It carries forward, and you can access it for up to 5 financial years. So if you only used $10,000 of your cap in the 2022-23 year, you have $20,000 of unused cap space that you can still access today, as long as your total super balance was under $500,000 at the 30th of June last year. That $500,000 threshold is the gate that determines whether you can access carry forward or not. The upside is real. If you have a high income year, maybe you sold an investment, got a bonus, or are in a strong earning phase, you can make a large concessional contribution that covers multiple years of unused cap. That contribution is taxed at 15% inside super instead of your marginal rate. At a 37% marginal rate, that's a 22 percentage point, saving on everything above $30,000. On a $90,000 contribution, that difference could be worth more than $19,000 in tax. But here's where it can go wrong. If your super balance is close to $2 million, dumping a large sum in through carry forward could push you over the transfer balance cap. Let's say you have $1.85 million in super and you use $180,000 of carry forward space. You're now at $2.3 million, above the cap. That $30,000 excess can't go into the pension phase. It stays in accumulation, earning returns taxed at 15% instead of 0%. The tax deduction you claim today might be partially offset by extra tax on earnings for the rest of your retirement. Unused cap amounts also expire after 5 years. If you had low contributions back in 2020-21, that unused cap space will expire at the end of this financial year. You either use it by the 30th of June or it's gone. The carry forward rule is a genuinely useful tool, but it's most powerful for someone whose balance is well under $1.5 million and who has a high income year they want to take advantage of. The closer you are to the transfer balance cap, the more careful you need to be about how much you tip in at once. Now let's look at a strategy that does something different. Instead of adding more money to super, it changes the tax classification of what's already there. Your super balance isn't just one pot of money. It's made up of two distinct components, a taxable component and a tax-free component. Most people have no idea this distinction exists, and most of the time, it doesn't matter much. But when you die and leave super to someone who isn't your spouse or a financial dependent, that taxable component gets taxed at up to 17%. So if you have $500,000 in super, and most of it is taxable component, and you leave it to your adult children, they could pay up to $85,000 in tax on the inheritance before they ever see the money. That's not a theoretical risk. It's how the system currently works. The recontribution strategy is a way to fix this. Once you've reached your preservation age of 60, for anyone born after the 1st of July 1964, and you've met a condition of release, for example, you've fully retired, you can withdraw a lump sum from super and then contribute it back in as a non-concessional contribution. When you do that, the money re-enters super as tax-free component. You've effectively changed its tax status. The non-concessional cap is $120,000 per year. But if you're under 75 and your total super balance is under $1.76 million, you can use the bring forward rule and contribute up to $360,000 over a 3-year period in one go. That lets you convert a substantial chunk of taxable component in a single move rather than drip feeding it over many years. Here's the trade-off to understand clearly. The path where you leave a large taxable component in super, your estate pays up to 17% tax on that portion when you die, reducing what your children receive. The path where you use recontribution over time, your beneficiaries receive the full balance tax-free. Over a 20-year retirement, even small amounts of recontribution can save your family tens of thousands. The catch is, you do need to have met a condition of release to withdraw the money first. You can't do this while still working full-time if you're under 65 unless you've met the definition of retirement, and you need enough non-concessional cap space remaining. But for someone who has retired at 60 or 61 and has a meaningful taxable component, this is one of the more thoughtful estate planning moves available. Recontribution only works if you have unused non-concessional cap space. And understanding that connection brings us to something many people don't talk about enough: why we keep delaying these decisions even when we know we should act. Here's something that's worth sitting with for a moment. The biggest reason people don't use these strategies isn't lack of money. It's not even lack of information. It's overwhelm. Super rules are complicated. The deadlines are confusing, the thresholds change every year, and when something feels complicated, the brain files it under "deal with it later." Psychologists call this status quo bias. We stick with what we already know, even when staying put has a real cost. I get it. You're busy. You might still have a mortgage. Some of you are helping your kids with rent or deposits while also trying to sort your own retirement. The last thing you want is another financial task on your list. And when the tax return lands, the idea of figuring out whether you qualify for the co-contribution or the spouse offset can feel like one more thing to get wrong. But I've been there myself. I put off doing a spouse contribution for 2 years because I convinced myself it was too complicated. When I finally sat down and did it, it took about 15 minutes and saved $540. 2 years of telling myself it was too hard, and it turned out to be a 15-minute job. That's what delay actually costs. Not just the money, but the mental weight of having something unresolved. The co-contribution, the spouse offset, the downsizer rule. These don't require you to become a super expert. They require you to know the threshold and take one action before the 30th of June. So here's a concrete thing you can do right now. Pick just one of the three strategies. If your income is under $44,500 this year, transfer $1,000 from your bank account into your super fund as a personal after-tax contribution before the 30th of June. You don't need to call anyone. You don't need a financial planner for this step. You log into your super funds portal, find the option to make a personal contribution, and transfer $1,000. The ATO does the rest. The hardest part is starting. Once you've done it once, the second time takes 5 minutes. We've covered the three main strategies in detail. But the video topic promised 10 retirement planning strategies, so let's quickly run through the others. Not as deep dives, but with enough information that you know whether any of them apply to your situation. Salary sacrifice. You direct pre-tax income straight into super, where it's taxed at 15% instead of your marginal rate. The total concessional cap, including your employer's super guarantee contributions, is $30,000 for 2025-26. If you're earning above $45,000, this is the most straightforward way to reduce your tax bill this year. Personal deductible contributions. If you're self-employed or your employer doesn't offer salary sacrifice, you can make a personal contribution and claim it as a tax deduction in your return. Same $30,000 concessional cap applies. You need to lodge a notice of intent to claim with your super fund before you submit your tax return. The bring forward rule. If your total super balance is under $1.76 million, you can contribute up to $360,000 in non-concessional contributions over a 3-year window, triggering it all in 1 year. This is useful if you've received a large inheritance or sold a business asset and want to shelter as much as possible inside the super tax environment. Transition to retirement pension. If you've reached 60, you can start drawing income from your super while still working. The maximum withdrawal is 10% of your account balance per year. Withdrawals are tax-free once you're 60. This isn't for everyone, but for someone who wants to reduce their working hours without reducing their income, it creates flexibility, super splitting. After the end of each financial year, you can roll up to 85% of your concessional contributions across to your spouse's super fund. This is different from the spouse contribution offset we covered earlier. Splitting is about moving contributions you've already made. It doesn't give you a tax offset, but it helps balance two unequal super balances over time. Remember, all of these strategies are linked to your total super balance. The number that matters most across almost every strategy we've covered today is your total super balance, because it determines whether you can contribute more, whether you're near the transfer balance cap, and whether you're eligible for the lower threshold strategies like carry forward and bring forward. Check that number before you do anything else. Let's bring this together. The three strategies that work even when your budget is tight: the government co-contribution, which gives you $500 for a $1,000 personal contribution if your income is under $44,500. The spouse contribution tax offset, which gives you $540 back in tax for a $3,000 contribution to a spouse earning under $37,000. And the downsizer rule, which lets you contribute up to $300,000 from a home sale outside the normal caps. As long as you're 55 or older and the property has been owned for at least 10 years. The one number to check before you use any of them, your total super balance. If you're approaching $2 million, the carry forward rule, the downsizer, and the bring forward rule all interact with the transfer balance cap in ways that can cost you more than they save. Know your number first. If you're a pre-retiree who wants to make the most of every dollar you have, without complex strategies or large sums you don't have, subscribe to the channel. New videos go up every week, covering the numbers and rules that actually matter for real Australians getting close to retirement. You don't need a spare $30,000 to build a stronger super position. You just need to know where to look. I'll see you in the next video.